What is up? Good morning, everybody. Happy Friday. We made it. Welcome to PreMarket Prep. Spencer Israel, Joel Elconin, Dennis Dick. Guys, what is there to say? We are continually at the mercy of the next headline. Uh, we markets just ripped higher like a half hour ago because apparently Vladimir Putin said that there are positive shifts in peace talks. Raise your hand if you actually believe that? I don't know. The market did. The market believed it. We ripped higher. So we'll talk about that. We'll talk about whether that's a fake out or a breakout. We'll talk about DocuSign. Holy cow. Rivian. We'll talk Oracle. Great guest today, Cameron Dawson from Fieldpoint Private. She's their chief market strategist. Hey, Dennis, what's up, man? There he is. So a lot to get to on the show. Smash that like button. Here we go, everybody. Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. All right, good morning, everybody. Welcome to the show. I got Joel, I got Dennis, I got charts. Well, Joel has charts. Joel, I just mentioned how we ripped higher a half hour ago on yet another headline. Tell us about it.
I don't know what to say. I mean, there's days where I'm at a loss for words. I'm at a loss for words here.
What's the headline? Tell us the headline.
It came from Reuters, and the Reuters quoted Vladimir Putin. And the quote was this: "There are certain positive shifts. Negotiators on our side tell me," Putin said in a meeting with his Belarusian counterpart Alexander Lukashenko, adding that talks continued, quote, "practically on a daily basis." Putin did not elaborate, but said in the televised remarks that he would go into more detail with Lukashenko. That's the extent of it. That's it.
That's enough. Positive talks, algos, read only positive talks from that headline. They don't read the article, and
There's no article. There's no there. That I read you the article.
Oh, okay. Well, that's it. And
Two sentences.
we know the algos. They see positive talks, they buy, and they don't ask any questions. It's a simple program. Algorithmic trading is so simplistic. At least the best programs are simplistic. Positive talks, de-escalation, buy. Negative talks, escalation, sell. There is your algorithm. That's what's making the money right now, and it's killing it. So, I mean, now they got to turn around, and I hope they take the profits right away, because what a rip-roaring, rip your face off squeeze there at 6:30 when that headline breaks. But again, I'm going to reiterate what I've been saying nonstop for the last month. We're in a headline-driven market. Nothing matters except the next headline coming out of the Ukraine.
But, it's so hard to separate. I mean, obviously, the news is the news, right? And you can't predict or especially in this market environment, what's going on. But if you just like the price action from yesterday to me was good price action. It was constructive. Yes, we were down on the day. We opened lower. We took out the pre-market low. Things looked a little saucy there. It looks like we do some more work in the in the 4200 handle. But then from about 115, 130 on, there was a really strong bid in the market. And 55 handle rally. I looked at it from 115 on, and so I'm thinking, okay, I'll try and buy the dip, overnight if there's a dip. Well, I bought the dip, and I got stopped out of the dip. And it's just so hard.
Stops are stopping. You're getting stopped out of everything right now if you're using stops. That's one thing. We're in such a choppy environment, because think about what a stop really is, and it's a good lesson. A stop is selling the dip and buying the rip. That's really what it is. So, I mean, you're trailing stops on something. When it dips, okay, oh, I got stopped out. What are you in essence doing? You're selling the dip. So stops or risk management is really struggling right now. Traders who are really using tight risk management are probably really struggling. So you got to loosen it up. That's the only way. You got to loosen it up. You can't be coming in and saying, I'm going to stop myself out if I get down 1% in this thing. You get stopped out everything. So you got to go wider, and you got to be, timing of your entries are critical. And that's why you can't be chasing anything in this market. Like my Halliburton buy. I took 0 heat on that. 34, I bought it $34 when it was tanking, but I didn't buy it right on the initial tank, and then it started to stabilize. And if you look at the chart, look when I strike on that. And I was putting it, so you see where it was all stabilizing around 34, Joel? We had the initial whoosh, the initial flush. So go back, if you point out, you're going to 2 days ago.
You want to go on the 60-minute?
Yeah. Top left chart.
Okay.
And look at the
that's a 15-minute.
Look at the first flush and then the second flush. It's on the second flush. See the second flush, that boom?
Yep.
And then all the stabilization at 34 afterwards. Look at all the stabilization. Did not want to go through it. You could see buyers starting to accumulate. Now, you already had in your head, you're buying on an overall uptrend here too. This isn't like buying the dip. It looks like it is on that chart, but on an overall, if you look at the right chart, the top right, so many damn charts there, you can see Halliburton's clear uptrend. So you're buying a dip on a strong stock. And what happened was, boom, 34. And I never took any heat on it. I don't even know if I was down a nickel. Like I literally took, I think I bought 34.05 and it never went through 34. So I was down like 6 cents. No heat. So you got to really time your entries. And then it goes 35, 36, 37. And I ended up selling it yesterday because you know what? I made 11% one day. I'm like, when you make 11% one day, you take the money and run. And, maybe I'm going to get a chance to rebuy it here. It comes back down to the 34, 35. I'll probably rebuy it again. But that's the market environment we're in. Take the money and run when you got it. And you got to really, be looking at trying to, stops are tricky, but you really got to be critical with your entries.
What about something else here? And we'll make this we'll turn this into a little learning experience here too. And I don't know if this factored into your trading at all, or your investing or whatever, but what was 34? What was 34 in for a good part of February?
Oh, resistance. It did. Yep. I looked at that too. And
okay.
I think I even said that with the purchase. I mean, we had 34. So old resistance becomes new support.
Simple. Simple.
Yeah.
Simple.
It technically worked. So technicals can still work. You've just got to, get in there. And obviously in the absence of headlines, we know it's, all that works. So, but it's the next headline that's going to drive the next price. So now you get, a headline and Halliburton's going down today because all of a sudden, there's a perfect inverse correlation between oil stocks and the SPY right now. That doesn't exist long term, but right now it is existing big time. When the SPY is going up, the oil's going down, the oil's going up, the SPY is going down. That's just the way it's working right now. So understanding those relationships too are critical, but we don't know what the next headline is going to be. Maybe Ukraine comes out and says, we haven't had any good talks. And the market's going to tank. You don't know.
There's probably better than a 50% chance of that happening.
Yeah. There's gonna be 25 more headlines: positive, negative, positive, negative, positive, positive, negative, negative. That's what's gonna happen. And unless we get eventually get a deal signed and it's over, and on that day, this market is going to rip so fast. I mean, if they get a deal signed, and this is just all scenario analysis, why I wouldn't want to be really short this market either.
You can be.
Because if they sign a deal and it's over, like, they're going to stop, a ceasefire deal, this market could rip, it could rip 2,000-3,000 Dow points on that. I'm not joking. So it could rip huge on that. But then it'll rip on that, and then everybody like, well, wait about interest rates. So there's still that one that nobody's talking about yet, but interest rates are still a concern here too. So I think it's all about balance right now. Nobody knows, and again, I'm going to say, if you're listening to somebody and they're telling you where the market's going to be for 6 months, stop listening to them because they have no idea what they're talking about. Nobody, not one person except maybe Putin knows how this is going to end. Nobody knows. So it's all just little spots, guesstimations, playing chop. That's how you're making money right now, playing the chop. taking the money when you got it. You get 10% gain, 11% one day in Halliburton. Take the money. Take the money, because you know what? The next headline is going to be, oh, exactly what's happened overnight. Oh, we're having a little bit of talks, and Halliburton's down $1, and maybe it falls $2. You don't know. So you got to take the money while you got it. We got a huge dip in Halliburton, bought it on a strong stock, buying dips on strong stocks, and then we get the huge rip 24 hours later. What do? Sell the rip. So will I get it back? Probably. I mean, my square too, same thing. I mean, I've seen it just multiple times. I almost got back to my price yesterday, but didn't get back under 100. Will I rebuy it under 90s again? Probably, because it's worked 3 or 4 times. So again, just playing the chop. You're buying dips, selling rips. I know I keep repeating myself, but it's the people who are chasing that are losing money. You don't want to chase in 2022.
That's the story. And the point about this whole thing being over in 1 minute, like that's a possibility.
It is.
So like we just don't, obviously no one can say if or when, but it's on the table.
It is.
Right? And
oh yeah.
So
that's what you got to know. If you are massively short this market, that's your risk. That they sign a ceasefire agreement, this market will be up so fast you will not even know what hit. The algos will go nuts. The algos go. We take it up 60 handles, Joel. There's a positive. There's a little bit of positive talks coming out from Putin. Could you imagine a ceasefire, like agreement signed out of the blue? It would be insane. But I'm not saying we can go long, because we don't know. We don't. This could go on for a long time.
You almost feel like the opposite headline. It's like you always you have to do the opposite. Like this headline came out and it's positive. Now you had. I mean, it's just the way this has been going.
Yeah.
Now you almost gotta wait. It's just not going to be that smooth. And who knows?
Maybe that's exactly it. It's just none of it's going to be smooth.
Maybe he's just waiting, maybe, okay, I'm going to act nice a little bit, and he's, drumming up another 150,000 troops. I mean,
Could be.
Yeah. I mean, it's very, 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 very hard to predict. I mean, we're kind of cratering now as we speak.
Well, because probably next headline's going to be, I don't know what this guy's talking about. We haven't any talks at all.
That's going to be
That's what's happening. That's what keeps happening. So you got to sell. What am I doing? What was I doing this morning? When we rallied like that, I'm trying to sell stocks. I'm like, holy crap, we're up 60 handles on this, trying to sell stocks. It's what I'm doing. And you know what? It's working. I was selling stocks at 431, 40, SPY, so 432. I mean, now we just started puking here again. So it's going to be like this. Get used to this. This is the market environment we're in right now. And even after the ceasefire, then he still got interest rate concerns. So I just don't want to be like, people keep saying, well, you got 45% cash. What are you doing? Well, I'm a market timer. It's my job to time the markets. What I do for a living. I'm not confident enough to go all in right now. In 2020, it was awesome. You're going all in. Yeah, people are on margin. People are buying stocks. I mean, if you're doing that right now, you are in the wrong market environment. And maybe you'll get lucky. Maybe you're going to buy on margin, and maybe you're going to get a ceasefire agreement. You're going to kill it, and then you're going to say, Dennis didn't know what he's talking about. It's all about risk. You got to analyze risk too. Like I said, it's difficult to manage risk when you get stopped out of everything, but you can't just go all in and then all of a sudden, there's a bad headline and, you're eating it. I don't like losing money. That's how I've been successful in this business for 22 years. It's not about that I like making money. It's that I don't like losing money. So you've got to have risk management, but you've got to be wider right now. So go smaller and go wider with your stops. You still got to stop out. When you're wrong, but you got to go smaller and you got to go wider.
And then Double T is playing chess here while we're all playing checkers. He says, let's not forget, good news is bad news. The Fed is watching. That's a whole other thing.
That's that's what we're going to have after. That's what we have to look forward to.
Yeah.
So once we do eventually get a ceasefire, and I hope that happens, that it doesn't escalate into obviously a lot worse situation. But even if that does happen, then we're like, oh yeah, interest rates are still going up. Oh yeah, hyperinflation is still here. There's 3 main things happening here. We got a war. We got, maybe it's not hyperinflation, but it's serious inflation. Hyper is a loaded word.
All right,
we'll say serious inflation.
Down a little bit on the hyper.
Serious inflation. And we've got interest rates that are going up. None of this is good for stocks.
And if you think about the other headline that was out overnight, which I saw, was that he was moving more west, making more advances west. And
I
you're
know,
like,
I know,
uh-oh,
Joel makes no sense.
go east, baby. Don't go west. It's just very, very
It
difficult.
doesn't
But
make sense. All right, but let's move on. Let's talk some
Nothing makes
individual stocks here.
sense.
Nothing makes sense anymore. Let's talk about
what's Dennis's shirt? Everyone wants to see Dennis's shirt.
Oh, I've wore this one before. It's like it's a playoff of
straight down to Windsor.
What is it?
Joel doesn't know Compton. NWA.
Dennis is the whitest person.
It's straight out of Compton. The name of NWA's awesome album, and this was the thing. I got straight out of Windsor.
Dennis, how long?
I love NWA.
How long
I
ago
always
did you
loved
I don't
NWA.
think you wore that before.
How long ago?
I was born. I'm born in '76. I love the gangster rap. Who doesn't love gangster rap? I love gangster rap.
Look at Spencer. Snoop Dogg, really? Can you
Snoop
do?
was good. Oh yeah.
Can you do any of those? What's your favorite Snoop Dogg song?
Gin and juice. You got to go gin and juice.
Classic, no doubt.
Yeah.
All right.
Sipping on gin and juice, laid back with my mind on my money and my money on my mind.
That's why he likes it, just for that line.
That's the
All
line.
That's the line.
Oh boy, hope Cameron's not watching.
She's not.
Oh, Cameron, Cameron, she like gangster rap. I bet you will ask her. I bet Cameron likes gangster rap too.
All right. Can I'm moving us on here to DocuSign. This is kind of your.
Yeah, Spencer's like, oh my god, what are we gonna do?
This is your mover of the morning here. Your big disaster earnings report from overnight. I'll give you the numbers and then I'll give you some context to it. So the EPS 48 cents. They beat the estimate by a penny. Sales of 580 million versus a $561 million estimate. So they beat on EPS to beat on sales. That's good. So why is the stock getting crushed? I'll give you a few reasons. Number one, the guidance. Q1 sales guidance came in below estimates. Fiscal year guidance, sales guidance also below estimates. Number two, and I can pull this up in the Pro, this was the first quarter in since they've been a public company, which is only since 2018, first quarter where they had an EPS decline. Their earnings per share actually went down on a quarter-over-quarter basis here. So the money line seems to have been from on the conference call. I'll read you from the call right now from what the CEO said. He said, while we excel at demand generation for many years pre-COVID, ultimately the shift in customer buying patterns coming out of the pandemic was quicker than we anticipated, and we didn't move fast enough as an organization. Blah blah yada yada yada. They're turning the ship around. Our move from capturing high volumes of customer demand to reverting back to generating demand is now well underway. We expect this work will continue through fiscal year 23 as we make tangible progress throughout the year. So, demand fell off a cliff faster than expected, and they're going back to having to basically pay more for customers, higher customer acquisition cost. It's not that easy anymore as it was during COVID.
Somebody tweeted out the tweet. Twitter is awesome with some of the people. Some of the people are so witty, but they're like, oh, everybody in the market just realized that you can do what they do with a pen and a paper. I'm like, kind of. Anyways, Spencer didn't like that, but
no.
Simplistic is what it is. I mean, it's a very simplistic business. It's just valuation. I mean, I use DocuSign, buy real estate, sell real estate. Use DocuSign for lots of things, but it's too simplistic. Like, I mean, this is it. This is what you got. You're going to pay billions of dollars because they took the pen and the paper and they put it online. It's a lot of money to pay. A lot of big valuation. What's the market cap of this?
It's an amazing service. Let's be clear.
Amazing service, but all they did was this simple. Okay, well, we're doing pen and paper. Could we do that online? Yes.
What's the market cap? Well,
this wasn't reinventing the wheel. It just made it a little bit more round.
I don't know what it is now, but as of the close, it was $18.5 billion.
Yeah, you're paying $18.5 billion because they took the pen and the paper and they put it online. Yeah, a lot of money to pay. It's an awesome business. It's worth something. Is it worth $18 billion still? It definitely wasn't worth $70 billion when we were paying $70 billion for when the market was just unbelievably irrational back in June, July, August, September, October of 2021. Is it going back to $70 billion? I will say right now, I believe DocuSign will never go back to $300 a share unless they do some other stuff and they reinvent themselves. But it's a one-trick pony, really. Is it not? Do they have other tricks?
There was two things I forgot to mention. One, they announced a $200 million buyback. That's kind of small. Two, their chief revenue officer is resigning.
In any regard, Maybe it bounces. It's massively oversold. Not going to be short it down here at $77. It's way oversold, but I'm not buying this and saying, well, eventually it's going to go back to 300. What rational thought can bring you back to 300? They've got to do a lot more than just take the pen and the paper and put it online. Maybe they do, and maybe they change themselves up. But as of right now, it's really a one-trick pony business. So show me some more tricks, and then maybe I'll get interested.
Gotta agree there with the fundamentals. The technicals, I'm just gonna pull one out of the playbook from yesterday, and I don't know if it's gonna work. 76, right? I mean, there's no doubt someone has a little opinion here at 76, right? I don't know if they're, long the 90 puts, or they're trying to build whatever they're doing. There's some buying interest at 76. I don't have anything on the monthlies, but I'm just going to go back to the Asana chart from yesterday. And your pre-market low was touched in the regular session, and you ended up, that's just look at the chart and see if there's some buying interest. So buyer beware. Whether they're going to pay 77, 78, 79, or 80, I don't know. But if you're looking to cover short or try long, that's what I'm looking at in shares of DocuSign.
And you have Asana up there. Oh, there we go.
Well, I did because I wanted to show what happened in Asana yesterday.
Yeah.
I'm trying to illustrate.
Yeah.
That was the pre-market prep stock of the day, right? Pre-market low matched the June 2021 low, as illustrated right here. But I don't have a monthly low for you. That's the only thing that says, But DocuSign is a
mad respect for the Asana CEO though, still for putting his money.
Yeah, we love him. I put that in the article. I put that in the article, Dennis, that you said.
1.2 billion he's bought in the last soon. Mad respect. Doesn't
matter. And so this morning, just follow up on the DocuSign. You're getting 1, 2, 3, 4, 5, 6, more than a half dozen analysts coming out who have to play price target.
Oh, jeez.
But they still have neutral ratings and bullish ratings on the stock. So the other catalyst here is what happens when the street turns on. I mean, the analysts. What happens when the analysts turn on them and start downgrading this thing to underperform, to sell? That's another catalyst that we haven't even gotten yet, because the analysts there are still mostly positive on the stock, though their price targets are way
many wrong.
I wouldn't even for something.
Do you notice
like
how
that,
quiet it is in the analyst community?
We don't even talk about it.
So quiet. You see like a few ratings. We just get like 30, 40 ratings changes a day. You get like a couple major ones, maybe one, and then you get like a 10 or 12 smaller ones, and they're going to neutral. There's no like convicted buys coming out here, and the market's crashing. Aren't you gonna buy some stocks? No, they're too scared. Props to Michael Pachter, though. We love him. He's the best. He's our favorite. Is he our favorite analyst?
He upgraded Netflix.
I know. That's what I was going to say. Upgrade Netflix. And you know what? He admits when he's wrong. This is why I love Michael Pachter. He's on CNBC there yesterday and talking about it, and he's like, well, it's come back down, and it's back my price target, so I went to neutral. He's like, I was wrong on this for 10 years.
I know. That's exactly what I said.
I've been wrong on this for 10 years. But it came back down to my price target, so I'm going neutral.
We talked about that. I don't know if that was the day you're off. It was like, you talk about wiggling out of a bad trade or something. He was wiggling and wiggling, and he finally got.
He admits it though. Like so many analysts make excuses. Oh, well, this happened or this happened. He's on there. He just says, "I got this wrong for 10 years." I'm mad respect for that. This is the successful analysts and the successful traders in this world, and the successful people in this world. Just admit when they're wrong and fix it. Don't sit there and make excuses and try to figure out, why you're still right. No, you're wrong. Stop doing what you're doing and fix it.
Do you know who hit it out of the park? You were
admit when they're wrong and identify quickly and fix the problem.
Don't put Gene in that category. He was on Wednesday, the day you were out again, and we threw some tough questions at him, and he talked about what stocks he was looking at, and so obviously he's the perma bull, but he's been cautious, and he mentioned he was looking at Zoom. Dennis, did he say he had a position in Zoom? Spencer, or was he waiting on it?
He was I don't know if he was actually long, but he was bullish. He was definitely bullish Zoom.
Yeah.
Call me about
How oversold is this thing, though? Look at this chart. This thing is just straight down,
6 for
barely
1
a
stock
rally
split.
from 300 to 100. There's been a few little vicious squeezes in there,
600.
but it is a draw. Take your Jeff Mackey, Jeff. Hey, Jeff. We always give him the shout out. Jeff Mackey, purple crayon on that top right chart, and draw the line. And don't even think about buying it until it starts to break that purple crayon to the upside, because this line just continues to
Should I
go
do a trend
down.
line?
Yeah.
There's absolutely no reason to be a hero and say Zoom has bottomed. You know, you can say from a valuation perspective, but until that trend, that purple crayon trend, I'm looking at the top right one. Do it on the top right one.
How about
right one's better.
top right? Okay.
Yeah, that one's better. The top
I
right.
finally
top,
got one right,
yeah,
and
do
then he wants me to
do
do
the top
another
right one. That one's too steep.
I know.
Take
I
that.
know, Chris. I also
Draw the line. Jeff Mackey, it's not purple. It should be purple.
Well, give
That's
me a
okay, though.
second, man.
There it is.
Oh, that was
Sure, we'll
pretty
go
close.
with that. Good enough. Until it gets
Oh!
above that line, it's a no touch for me.
Oh, look at this.
Until
This
it
is
gets
gonna be
above that
fun.
line. No
Right.
touch.
Right,
The bounces, people are going to make some money.
We're having fun. We're having fun with trend lines here. While Joel's doing that, let me move on here to the next stock. Although it's going to be more of the same, I'm afraid.
Ooh,
Rivian.
nah.
Rivian.
Oh,
This was
gosh.
a disaster. Whatever the true cause of them massively lowering their delivery guidance is, whether it really is global supply chains, or it's just the fact that making cars is really, really hard. Whatever the reason is, I don't know if we'll ever know the true reason, but the bottom line here is Rivian has massively lowered the bar for themselves. They lowered the numbers are what they are. The losses are widening, and then they said that their target is 25,000 cars this year, which is half of what they said during their IPO roadshow. Half. They guided to make 25,000 cars this year, and
what was that noise? Was that you, Dennis?
Yeah, I'm just vomiting just thinking about this.
I mean,
this is still worth $33 billion, Joel. They haven't even made a car. What are people doing? Like, they bought this up to $179 a share back in November. What was the market cap then?
God, I don't know.
5 times that. It was worth 150. It was worth more than General Motors and Ford combined. And they never
Tesla,
made a car before.
Everything combined.
That's how stupid people are. Like, honestly, anybody who bought that $179, there's no other excuse. You just weren't doing your homework. We've hated this stock since birth, which means in November when it was $100, I was like, this doesn't make any sense. On 120, 140, 160, definitely wrong for the first 5 days. Hated it the whole time.
Wrong.
Gonna keep hating this stock. So is it oversold? Yeah. Is it gonna have dead cat bounces? Yeah. Is it worth $33 billion? I don't think so. I think it's worth, like, I don't know. You can't put a value.
How do you know?
It could make cars. It could eventually.
Wait, don't they just make that ugly looking van?
I don't know. Do they make any? They haven't made a car. Have they ever sold a car yet?
The term ugly is subjective.
Put it up there. It's like
it's
like these vans. It's that you've been seeing that that it's been out like it looks like a Scooby-Doo van.
No, it doesn't.
Yes, it does.
No, it's not like a Scooby-Doo van.
What was the Scooby-Doo van's name?
The
mystery machine?
The mystery mobile, whatever. That does
Oh,
not.
it looks like a sport track. That one on the left, the Ford Sport Track.
And
Ford
that's not the one I'm
Ford
thinking
invented
of.
that a decade ago. I had one. It was a cool car 15 years ago. They just copied that from Ford.
Remember, they also just raised prices, and then they had to backtrack because everyone was like, "You're raising prices on now," and they're like, "Oh, okay, our bad. We're gonna."
All right. Just want to state here for Dennis, they produced 1,015 vehicles, delivering 920 last year.
Oh, they made 900 cars. Okay,
Yeah,
that's a start. That's worth $33 billion. That's the market cap today. So people are saying, well, I'm going to buy Rivian. It's so cheap. Is it cheap? It's worth $33 billion still. How is that cheap? If it was $3 billion, I'd be like, okay, well, maybe this makes some sense. But that would take it to $3.70. So I maybe at that point in time as a value investor, I might say, okay, I can see potential here. You bought, when you're paying $100 billion for this company back when it was over $100 a share, there's no upside. It's all priced in. It has to be perfect to even get to that. And obviously it's not going to be the case. The supply chain issues and everything else is hitting them too. Move on here. Better stories out there. Better stories.
Yeah, that's the bottom line here. It's going to be tough. Maybe they can do it.
Common sense wins in 2022. Use common sense. Do your fundamentals. Take 5 minutes. Look at the market cap. Look what you're buying. Don't look at price. Look at the market cap, because the market cap will tell you a lot more. What are people really paying for this? Is there the potential for this to grow into a huge company? When they start with a market cap bigger than General Motors, and they're a concept really at that point in time, how does that make any sense? They're not all going to be Tesla. They're not all Elon Musk. I mean, we got Tesla dead wrong for a long time. I mean, Elon Musk is a genius, and he's figured out so many different things. And, that's a reason Tesla. But not all of these EV companies are going to be Tesla. Like, do you think Ride is coming back? Do we think Lordstown Motors is going to eventually be back at, like, where was the all-time high on this puppy? $32?
Look how many times it went up there, too.
Why can't Rivian go to $2? It could. Not saying it's gonna, but not saying $33 billion is not cheap. They better start producing some cars, a lot more cars.
There's a lot of these companies out there too. All right, let's move on quickly. We're going to bring on Cameron Dawson. There's just a couple other movers I want to get to. PSO, Pearson, anyone that's been to college in the last 20 years knows what Pearson is, the maker of those expensive, overpriced textbooks. Apparently approached twice by Apollo for a takeover that they've rejected both times. So PSO is trading higher because there's a cash offer on the table, and
Nice.
that they've said no dice to.
I don't know. 2.65% dividend it had, so at least he got some value there. I don't follow this company at all. What do? I don't even know what they do.
Textbooks. Yeah, okay. They're the company that charges you $800 for a textbook that you're never going to read.
Oh, this is real stuff, though. The stuff trade. Look, Apollo's buying the stuff trade, which kind of makes sense. I like it better because it's not online. Or maybe it is online.
No,
physical textbooks.
They have
I like stuff. I like buying stuff.
They have an online business, too. So
they have textbooks in college?
Yeah, right, Joel. Joel wouldn't even know about this.
Joel never bought the textbook.
Joel never bought a textbook.
Never bought the textbook.
You wait like 2-3 weeks,
And then you get a
they're on
discount from
sale.
the kid that drops out.
That's it.
Yeah, I don't know. I don't
like,
know.
I don't buy them. In 2 weeks, there'll be like half a dozen kids that'll drop out, and I'll buy their textbooks for 25 cents on the dollar.
Course
smart,
packs.
man. He
Do
arbs
you guys
everything.
have? Did you guys have course packs? Did you guys have course packs?
Sounds vaguely familiar.
Yeah, they would just they wouldn't be in the textbook, but you got to get the course pack, and it'd be like 300 sheets of paper or whatever. Yeah. I don't know. Whatever.
All right, wait.
Yeah. I don't know what's the price on this one. I can't really. Where they supposedly what's the cash offer at? Is it a takeout? So I don't know. What?
Okay. I don't know what the
it's already kind of probably our.
Is Barnes and Noble still around?
Trade's over here.
No, it's not over because there's no deal. It's not over.
Oh, it's just a rumor.
They rejected the deal.
Oh, anyways.
All right. Okay, quickly.
ADR, it's not on my number one list of trades.
Quickly,
today.
Oracle from last night. Earnings per share missed. Sales beat. They gave guidance on the call. That was good. They gave some EPS guidance above the estimate on the call.
I sold my Oracle sometime, and I don't even know when. I went to my portfolio, and I was like, I've still got Oracle somewhere. And I'm like, I don't. I'm like, when the heck did I sell Oracle? But I did. I've sold my long-term Oracle. I bought it back during the financial crisis for $9 a share. And at some point in time, I think where it was in my registered account, so I didn't have to pay the tax. That's probably why I did it. So anyways, I don't know where I sold it, but I'm out of Oracle. I'm actually disappointed that I'm out of Oracle, but I must have panicked sometime in there, and I'm out. So
wow, look at that. You got down to 70.25 on that initial dip, and look where your February low was. 70.23. Holy mackerel. $6 up that. You're not going to get another look at 70 for a while.
Cheap stock. This is a cheap stock. Yeah,
wow.
This is actually one that I've had for a long time. I actually probably should rebuy it.
Yeah, you should.
I probably should rebuy this stock.
Wow, that was quick. And then it rebounded back over 77. You know what? This is a little bit of a reset here. Because I keep an eye on 75 a little bit longer term. Because that was the lows in the last two sessions. You're above it. So will it make a triple bottom? Probably not, but at least there was buying interest there 2 days in a row. And then, if it really like it down there at 70.25, I don't think you're going to see that for a while though.
All right, let's bring on today's guest, Cameron Dawson, Chief Market Strategist at Fieldpoint Private. She was also kind enough to send over some very well-researched slides that I can't wait to get to. Let's get Cameron on the show right now. Cameron, good morning.
Good morning, everybody. Good to see you.
Welcome back. Did you read your textbooks in college like a good student? No.
I didn't. I think I bought them before the semester started, so I'm Pearson's best customer.
Yeah.
Nice.
Yep, and then resold them at the end of the year for a slight loss, like the rest of us. But Cameron, let's start overall here. We were emailing back and forth yesterday.
What about Dennis's question that he wanted to ask her?
Okay, fine. You want ask your question, Dennis? Go.
Oh, we started talking about gangster rap, and I was like, and then we said Cameron Dawson. I was like, I bet you Cameron likes gangster rap. Were you a gangster rap fan?
At times, I mean, I have a Britpop book behind me, so I think that's kind of
So
a little
maybe not.
bit more of the direction that I'm leaning.
Okay, no to gangster rap for Cameron. That's okay, though. But we love Cameron's market analysis. Let's talk this market. It's this headline-driven market because I feel like it's like we're up, we're down, headlines coming out of Ukraine. It feels like 10 times a day. How do you approach a market like this?
Well, I think that we have to start from the starting point of where were we before Russia-Ukraine happened? We were on the path for tighter Fed liquidity. And does the tensions in Russia-Ukraine change that path? And the message from the Fed has been absolutely not. We heard from Powell's March 3rd testimony that they're willing to sacrifice growth in order to control inflation, which means that even if we see weaker growth come from higher energy prices, higher food prices in response to all of these headlines, the Fed is going to focus on the CPI numbers, on the core PCE numbers, and say they're not coming down. And so we will need to continue to tighten policy. So the direction of this market means that the liquidity continues to recede. We're going to be stuck in this sideways chop, and that the Russia-Ukraine really doesn't change that because the Fed is set on that path.
Cameron, I want to bring up this chart. Last time you were on, you asked, "Are we there yet?" with reference to a bottom in the market, and you're asking that question again. But my question for you, as I bring this up on the screen, you want to see all of these indicators before you're comfortable saying the market is bottomed?
No, then you'd never be a buyer.
That's I'm wondering. Okay.
So these indicators are really, if you see all of these things hit, this would be indicative of a generational low, a back up the truck kind of scenario where it looks like the lows of 2020, the lows of 2008, 2009. And so this is more of a way to make sure that we're seeing and asking the question, if we're seeing so much bearishness out in the market, is that actually being reflected in positioning? Because that's been one of the weird paradoxes over the past couple of weeks. If you look at the AAII Bull Bear Survey, it shows that there are a lot of bears out there. But quite interestingly, nobody's selling. We don't see signs that there is a big positioning flush where you see people throwing the baby out with the bathwater, where fear is spiking so much that people are saying, get me out at any price. That's simply not happening yet. So what we think this means is that you can see relief rallies from here. We had the second to worst start for the S&P 500 ever on record to start this year. So a relief rally is expected. But is that ultimate low, that big strategic low that you can step in and buy indiscriminately, is that already happened, or is that still in front of us? And I think it's still in front of us. So you can look at the shorter term factors. A lot of these are longer term factors. And again, it's about the generational low if you hit all of those things. But we'd like to see a little bit more of these before we start getting really aggressive and starting to buy.
I want to hop in here for 1 second.
Mm-hmm.
Can you have two generational lows? I mean, was the COVID 2020 low, March 2020 low? Because it'd be, can you have a second one? Because that kind of felt like a generational low to me. But is it possible to get another one?
Well, we saw two once-in-a-lifetime bear markets in 1 decade in the 2000s. And I think this is all a reflection of, and this is all a possibility of the fact of we've had so much intervention into markets, and we can't get anchored to the prices at the end of 2021. That closing price at December 31st, 2021 was such a rarity. We had growth that was at multi-decade highs at the same time that we had crisis level stimulus. That combination should never happen, and it won't happen likely going forward because we have growth receding and stimulus coming in. So that doesn't mean we have to retest the lows of 2020, but we should be pulling back more to some of these trends before we really want to step in and get aggressive. What we've been telling clients is that if you're underweight in equities right now, if you are sitting on a big pile of cash, sure, start building positions into weakness. But we're not making the call yet to go big, huge strategic overweights into equities simply because we haven't seen that kind of flush selling that would be consistent with a really major low.
Dennis,
I mean, it's been
I think she's talking to you, Dennis.
For so many stocks here, and it's a lot of the growthy names obviously have been in a bear market for well over a year now, but this slow death, like just slowly bleeding. It's like some stocks, I look at them like, when did that stock get down to this price? And it was just slow, steady. It wasn't like a whoosh. It weren't all like PayPal where they're falling 25% in a day. Some just lost 2%, 2%. And then you look back 2 months later, you're like, that stock's down 50%. It's like, when did this happen? So there's no capitulation. There's no like everybody washed out. They're all holding, and all of a sudden they just looked and they're like, when did I get down 50% in there? There wasn't like a cataclysmic event. It was just a slow, steady bleed out.
But that point about no capitulation is so important. I think in the slides I showed margin debt. And if you look at the FINRA margin loan balances, a lot of the stocks that are very popular in retail accounts are down 40, 50, 60%, but margin loans have only fallen 2% in the last 6 months. So that tells you that people aren't capitulating. They're not throwing in the towel. And if they're getting margin called, they might be actually adding cash to portfolios instead of taking risk off the table. We can also see this by looking at ARK. So ARK is sort of the prototypical part of this trade. And the chart is just incredible. So one of the ways to measure inflows into an ETF is look at the number of shares outstanding. Over the course of the 2020 bull run, shares grew by more than 400%. They've only fallen by 13%, despite a 60% drawdown in that ETF from its peak, which tells you that there's zero capitulation here. People aren't selling, and they actually have been buying over the last couple of weeks. Lows do not happen when people are holding on to positions. Lows happen when they can't take it anymore. They give up. Just get me out of here. Get me into defensive. Give me protection. I can't take it. Now, that doesn't mean we can't see these counter trend rallies, because if you look at where ARK is trading or other tech stocks are trading versus their now downward sloping 200-day moving average, they're quite oversold on that metric. And so we can see bounces, but be very skeptical of those rallies, because as soon as you start to hit that overhead resistance, those downtrends are now so powerful. I would expect them to start to roll over and weaken, which means that the ultimate lows for a lot of these names also aren't in, and probably won't be in until we get that capitulation.
It's funny that you bring this up, because we were talking about this morning before the show even started. We were talking about the same exact thing, and I was noting that, there's been net inflows the last few weeks. People are still buying, which is pretty wild to think about in light of the performance of these funds in the last
It tells you that we haven't shaken that buy the dip mentality yet. And to Cameron's point, you're never going to get a capitulation here as long as people are still coming in and buying the dip. You'll see at the bottom when people are like, I'm not buying the dip. And obviously people are still buying the dip in ARK.
And the thing is, there's money to be made, of course, if you're a very short-term trader in the bounces off of oversold conditions. I think the last time that we spoke, we talked about how there were massive counter-trend rallies during the 80% drawdown of the NASDAQ in the early 2000s. You had rallies as large as 45% during that time, but the lows continued to happen. I mean, it's this death by 1,000 cuts. And so to keep that in mind, you just have to be very, very careful and not be drawn into bull traps, because I think that can be very dangerous as you start hitting that overhead resistance.
Good question from the chat. Who just asked this? Does there from Carmen? Does there have to be capitulation?
Not for a short-term rally, but there's been capitulation that sets up for every big bull market advance. That's what makes returns strong coming out of bear markets. It's that everybody's given up, everybody's bearish, and everybody's sold. And the fact that then there's a wall of worry that has to be climbed, the fact that valuations have been so washed out is what sets you up for multi-year advances. So if the call is just that, hey, maybe this can have a 20% pop because it's been so oversold, sure, that can happen. But if we're trying to make the call that we're going to have a return to the kind of bull market events that we had over the last 2 years or coming out of 2018, that call is difficult to make without capitulation.
And just to illustrate your point, or in the March 2020, I mean, people were just getting out, right? And it went down and down and down, and a lot of even the big funds, big investors, individual investors, and then it turned, and it turned so fast, that they did not have a chance to like redeploy those assets. And I mean, there were certain pauses in the market, but remember, everyone was waiting for the retest of we're going to retest 2200.
I
We
thought so
have
too.
to retest 2200,
Yeah.
and we never did.
Well, liquidity was so powerful. That was the point, is that despite actually the headlines got worse on the COVID front coming out of that bottom, but the liquidity that the Fed injected was so incredibly powerful that that's what set up for the advance. Now, here's what's really interesting when we think about the other times that we saw big bear markets or drawdowns over the last cycle. So 11, 16, 18, 20. Every single time the Fed stepped in to stabilize markets in one way, whether it was adding QE, backing off of interest rate hikes, or signaling in 2018 that they weren't going to have balance sheet runoff in autopilot mode, and they eventually cut interest rates. So the Fed stepped in to be that stabilizer for markets. But how does the Fed step in now when inflation, each of those times, was at or below their 2% target? Right. Now it's double their target. So it's really hard to see the Fed want to step in to be the savior of markets when inflation is so high. There's also one kind of nuance here, but it's so important. And it's that the Fed cares more about funding and credit markets than it does about equity markets. The Fed cares about the underlying plumbing of the economy working. It wants to keep that operating. That's why they inject liquidity. But a lot of the facilities that they put in place to keep markets, those funding markets, stable during the COVID meltdown, those remain in place. It's one of the reasons why we haven't seen acute funding stress over the past couple of weeks, despite all this volatility in global markets. So if the funding markets stay healthy, if credit markets don't completely seize up, why would the Fed have to step in and support equities? And so I think that's a really important question to ask when we think about where that Fed put is. What's the level of pain tolerance that the Fed would have to see before they step in to be accommodative?
All this being said, though, going back to the conversation about capitulation, I want to bring up this slide. We just international markets, looking outside the U.S., international emerging, international developed, getting crushed still. Cameron, is this not what we just talked about?
Yeah, I think that these markets actually could be getting close to capitulation. There was some interesting data that came out of the B of A fund manager survey just yesterday that showed massive outflows from international, mostly in European equities. And so when you see huge outflows and you actually have I think, multi-decade lows in relative valuation, we could be getting close. Now, you could step in and try to be a buyer and kind of catch a falling knife in some of these areas. And we certainly are seeing bounces off of oversold conditions. But I'd say before adding to positions, you need to be seeing some signs that this relative performance is turning, because that's what's hard. Until then, it's a value trap compared to the US. As long as that relative downtrend remains intact, and actually we've been making new relative lows, maybe not today because we're seeing those rallies, but I think it's starting to look more attractive because you are seeing that positioning flush, which you aren't seeing in the US.
You're making me never want to buy anything ever again.
Oh no, that's not my point.
I don't know what to do here.
Just saying we're not there yet to
Right.
go all in. We're
Fine.
not there yet.
Fine. And then I thought this was notable. Dividends.
Mhm.
You and I, Cameron, we were emailing yesterday, and you had noted the relative outperformance of the dividend factor this year, and I was surprised to see that. But then I looked under the hood and I saw, oh well, this particular fund that you're noting has a lot of Chevron and Exxon in it, so that's like cheating in 2022. I feel like, but dividends have outperformed the broader market this year, so I guess there is something to hang your hat on. There you go.
Well, so this fund here, which is the index of high dividend payers, it's an equal weighted fund. So it benefits, of course, from the surge that we've seen in high dividend areas like in energy. So that helps it a lot. But because it's equal weighted, it's about 80 constituents. That tells you that this is broad improvement for dividends. And I think that there's a valuation story to tell here. So if we go all the way back to 2017, dividends, high dividends were trading at about the same valuation as the overall market. But when the Fed pivoted and turned accommodative in 2018, when it cut interest rates when we were at a 50-year low in unemployment, that caused a massive expansion in the valuations for growth, tech, long duration stocks, and a collapse in the valuations of high dividend payers, those short duration cash flows that get you your money now. So that bottomed in 2020, and we're starting to see that valuation gap start to close, but they still traded a 30% discount to the S&P 500. So if the Fed, and we do think it will, continue on this tighter liquidity path, I think this valuation discount can close, which does help set up for better performance for those high dividend pairs. That's not just about, hey, the fact that the energy is rallying so much. So I think the setup for dividends is actually quite attractive in an area where I would be buying versus some of like the high duration tech names that could see oversold bounces, but certainly are in weaker trends.
So if tech is up here, dividends down here, and the gap closes, is it more of dividends catching up, tech coming down, or just a combo of the two?
Well, I think it's a combo of the two, but I think it's more tech coming down. And that's what we've seen this year, is that we've seen a big, huge drop in growth valuations, but valuations haven't actually gone up. And so the valuation compression in this market is all because growth is getting hit. And what's really interesting is that we've seen a very strong correlation between growth valuations and real rates. So real rates going down has pushed growth valuations higher, and real rates going up this year has dragged down growth valuations so much. But what's interesting, in the last 2 weeks, real rates have actually fallen again. They're back to negative 1%, but growth valuations aren't budging. And I think this is investors sniffing out that the liquidity environment is changing, that the environment for long duration is changing, and we're not seeing a bid to those growth valuations. So if we do see a little bit of support from growth, from those deep real interest rates, what we'd say is that would probably be a good selling opportunity to rebalance, because we've been wanting to be balanced from value and growth over the past few months because we saw this risk to growth valuations because of real rates.
Cameron, last time you were on, you mentioned it was before the Olympics and before the war and everything that was going on, and you talked about perhaps a rally in the Chinese stocks. And we got some bad news yesterday. Are you seeing any kind of setups here? Still sticking with that scenario? Just wanted to get an update on that.
Yeah, quite interestingly, the addition of liquidity into the Chinese market has actually surprised to the downside over the past few weeks post the Olympics. We saw M2 money supply growth decelerate. That's one of the key things that we're watching for, to see stimulus re-enter the market. And there have been signs that China's trying to stabilize this equity market, and it's simply not working. And so we saw this morning a lot of weakness in the H shares market because of the headlines about more constraints on the regulatory front. We're at multi-year lows in those markets. We could probably do some analysis to see if there's signs of capitulation, but we do think that China still has to stimulate its economy quite aggressively in order to be able to set up for that big party Congress meeting back at the end of this year. But there was another nuance when we were talking about that, which is that because because the regulatory environment in China, the crackdown on tech, maybe the better way to play China's stimulus is not within China, but within the periphery, and saying what are the areas of the market that benefit from China's stimulus. If China starts going back to infrastructure, does that help commodity producers and other Southeast Asian countries that feed into that stimulus? I still think that that's the better way to play China's stimulus, just because the regulatory environment is so difficult to tell, mostly as an outsider without boots on the ground, really difficult to have an edge in that environment.
I think you mentioned last time South Korea, Singapore, India, the other those types of markets that are around China. Cameron Dawson, Chief Market Strategist at Fieldpoint Private. Cameron, it is always a pleasure to have you on. Thank you so much for coming on PreMarket Prep today.
Thank you for having me.
Thanks,
All righty, guys, smash that like button for us for Cameron Dawson. We appreciate her time as always. I know we kept her a little long there.
I think she's number one on the most well-prepared list.
Oh, definitely.
That's unbelievable.
Dennis, you know what?
Very few people send us slides.
I'm like the least prepared.
Spencer.
She's prepared, man.
We didn't get how many other slides did she have, Spencer?
I don't know. There's like 20 more.
Yeah.
We didn't have time to cover.
We got to bring her back. Get onto those other slides. And everything she says makes sense. I mean, it's the exact opposite of like Kathy Wood. Like she's like makes perfect sense here.
Why
she's
you
like
gotta
exactly
go there?
opposite.
Why you gotta go there, Dennis? Why you gotta?
Just because Kathy's still getting inflows. Who's investing with her? I feel bad for these people. She makes sense. I'd invest in the Cameron Dawson fund. She makes a lot of sense.
DAWS is going to be the symbol. DAWS.
Yeah, we'll have a public symbol. Yeah.
All right.
That's good. Is it there? DAWS. We're launching our fund.
I don't know.
I'm investing.
It's 8:57. Let's do some ticker time for a few minutes here. Drop a ticker for us in the chat if you can. Okay, sure. Triple D. Can you look at Chevron? Yeah, let's look at Chevron. Why the heck not? It goes up every day. It seems like. Well, I'm not
just not noting. I mean, we are eroding here.
This is such, but Cameron is just talking about capitulation. Like we're getting to a point on some of these oil stocks where it almost feels like upside capitulation. This is getting silly. 140 to 175. I mean, some of the other oil stocks. Why is Chevron going so much more than the other?
I know.
Chevron's like usually a lower beta, but right now it's blasting off more than some of the other oil stocks. I mean, Exxon isn't doing this. Look at Exxon. In the last 2 weeks, 80 to 85. Chevron the last 2 weeks from 140 to 180. I mean, or 165, I guess, this morning. But the charts don't even look the same. I pair these up. I mean, Exxon almost revisited the level of broke out from Chevron, broke out from 140. So there's something happening here where I don't know if there's some squeezing going on or something, but Chevron, for some reason, is really taking off a lot more than some of the other oil companies.
Getting hit today, down $5. Let's see. What's the bottom of yesterday's range? Use 168.29 as resistance since you're trading below, and the all-time closing high. If that's not good enough for you, the all-time closing high was from yesterday, 170.82, and the other second all-time closing high was up there, 170.50. So trading down 172,000 shares. Oil's up. Look, maybe just have one big seller in there today, but trading down 2.5%. Next daily low, if you want to look at it, 161.29 is your next daily low.
And then at the rate we're going, Joel, give it another, what would you say, hour and a half, 2 hours, and we'll be back to where we started in the S&P futures right when that
leaking big
time.
Yeah, right when that Putin comment.
It's same story every day here. We're like Groundhog Day, the movie Groundhog Day. It just keeps repeating, and there's a headline, and then we go up on the headline, and then there's another headline, and then we go down on that headline. And I mean, the chop is there. The chop is there to be traded. But when you're ripping up 60 handles and you're like, oh, I got to buy something.
There's no way.
Just hit yourself a little bit. It's like, whoa, wait a second. I'm not supposed to be buying rips. Write that down. Take your sticky tab, and write down on a piece of paper. Buy dips, sell rips. Don't do the opposite. And it is working in 2022.
And then someone in the chat just said CVX is a short squeeze. It isn't. This is not a short squeeze. There is 1% of the float sold short. That ain't a squeeze. Yeah. It's easy to borrow. It's thick. There's liquidity.
Something else going on there, though. And maybe it's
Maybe,
something in
I
the,
mean, it also has the Warren tailwind.
is that what it is?
I mean, I'm just saying that that's the one that that he's been in, so that has a little bit of a go with Warren. It seems to be working quite well. That's even near all-time high. But
Like, it's the reason I bought Halliburton and not Chevron was a little bit of a catch-up trade, but also and a little bit different business. But just because there was no pullback in Chevron, I mean, even the pullback dip, we're not back at 140 where we broke out from. Like somebody was saying, look at Devon Energy. I mean, it hasn't even really went at all. I mean, again,
but
different
that had
business,
yeah.
a little bit, a
And
little bit of
anything
natty
could
gas,
happen.
a little bit
Only
different
Comcast
business, but not every energy stock is blasting off 30-40%. So is there some catch-up trades here?
And
Maybe.
if you ever wanted to know the power of some analysts, thanks to Mitch for reminding me about this. JP Morgan downgraded Chevron this morning. That's worth $4 here because it's down $4 this morning. Chevron is. So
that's why it's down more.
That's why it's down $4 is because JP Morgan downgraded. But again, they're basically calling a top here. So good luck with that.
It's tough. And again, I've tried to call tops many times my 22 trading years, and I'm usually not getting the top. It's a hard thing to call the bottom. It's a hard thing to call the top.
All right. It is 9:01, guys. We're going to hop. Joel's going to go over to premarketprep.com.
Yeah, I got Sean Udall coming on. He's going to talk, he's going to talk some Rivian. He's going to talk some oil. You love how he loves talking NASDAQ. So we'll see if he's trying to sell the rip here or buying a dip, and we'll talk to you guys later on.
We're going to hop off as well, go over to live trading with Benzinga. So guys, smash that like button for us. We appreciate wherever you're watching this show. If you're watching us on YouTube, on Twitter, on Twitch, on Facebook, even if you're watching us on LinkedIn, there's got to be like a thumbs up button on LinkedIn somewhere. So do us a favor, hit that button. Please remember that all the information from our show is meant to be used as informational purposes, not for investing or trading advice. Thanks to our guest today, Cameron Dawson. Reminder, we are 6 or so weeks away from the Benzinga Cannabis Capital Conference. Check out the details in the description of this video. Discount code 30% off with the code SHOWS30. Go to bzcannabis.com, enter the code on the screen there, SHOWS30 to get 30% off your ticket. As always, get Benzinga Pro. Free trial for everyone, pro.benzinga.com. All right, we're done. Live training with Benzinga. Benzinga going live in a few minutes today. No all access today, so you guys asked for more live trading. We're doing live trading. You give us feedback, you ask, and we deliver. So they're going live here, and I'm done. Good luck at the open. Thank you.